So topic number 1, that is advanced financial reporting and analysis. Topic 1. So topic 1 is assets and liabilities. Assets and liabilities, assets and liabilities, assets and liabilities. And I will start right away with the first item, which is IFRS 2. IFRS 2, IFRS 2, this is what we call share-based payments. So a liability accruing out of what year? Those shares or share options that we make promises to our employees. You tell our employees that if you guys work for us, for example, for 4 or 5 years, then we shall be able to give you the company's shares. It's a liability we are creating. We must pay them. You must pay them. So IFRS 2, share-based payments. I have some notes here which I'll be able to share with you after the class. So please, the most important thing is for you to be attentive here. That is the most important thing. You just need to be attentive. So in this case here, what is our agenda? What is our agenda for the class? What we shall be discussing today, we shall be looking at this IFRS 2 called share-based payment. And we've got 2 types of share-based payments. We have those share-based payments which will be settled through equity, where we shall give you shares of the company. We call them equity settled share-based payments. And then we have number 2, what we call cash settled share-based payment transactions. So by the end of today's session, all of us would have understood that in terms of this IFRS 2, we have got IFRS 2 share-based payments, share-based payments. We've got what we call equity settled, and then number 2, we have what we call cash settled, share-based payments. You can take your notes. So we have equity settled, share-based payment, share-based payment, share-based payment, share-based payment, share-based payment, share-based payment. And then we have in this case here what we are calling a cash settled share-based payment. So equity stands for what here? Basically shares. So here we shall be able to give you ordinary shares once in this case here the period we agreed comes to an end. We agreed you work for us for 4 years, you worked for us for 4 years, then we shall be able to give you what we call the company's ordinary shares. And the cash settled the share-based payments, this one here we normally use what we call share appreciation. Share appreciation rights. The share appreciation rights. The share appreciation rights. What we shall be abbreviating popularly as SAR. Share appreciation rights. The share appreciation rights. Share appreciation rights. So well, then what does this mean? This means that if it is RCM college, we are telling you that you guys work for us. And by end of the year, for example, like they do for these big banks like KCB, for example, Cooperative Bank, they tell you that currently our shares are selling at shillings 5. Come end of the year, if our share value appreciates, if our shares in this case here price appreciates, for example, to 8, then in this case here we shall be able to give you some bonus. We are not going to give you money here. We're not going to give you shares here. We shall give you money. We shall give you bonuses. But this bonus is based on share price, share appreciation. So basically here we are giving you ordinary shares, and here we are giving you a bonus, cash bonus. We shall give you bonuses here. We shall give you bonuses there, cash settled, share-based payments. So then the question that will be able to arise here is, if you're going to give us cash, why are we accounting for this under share-based? It's because the bonus we are going to pay you is pegged on share price. The bonus we're going to give you is pegged on what here? Share price. Is pegged on share price. Now, please listen and listen to me very well. Listen and listen to me very well. We are told here, under the introduction, that share-based payment schemes have become increasingly common. A share-based payment occurs when an entity buys goods or services from employees, for example, buys goods or services from other parties, such as employees or suppliers, and then number one, settles the amount payable by issuing its shares or share options. Or number two, incurs liabilities for cash payments based on what year? Its share price. Incurs liabilities for cash payments. You shall be paying them cash based on its share price. Now, please listen and listen to me very well. We have just mentioned here, and we are iterating again, that we have got IFRS 2 applies to all share-based payments. There are two main types. Number one, we have equity settled the share-based payments. The entity acquires goods or services in exchange for equity instruments of the entity. We are going to pay them, ladies and gentlemen, using shares or share options. That's what we call equity settled. And then we have a cash settled, a share-based payment. The entity acquires goods or services in exchange for amounts of cash measured by reference to the entity's what year share price. I would want, ladies and gentlemen, to repeat this once and for all. We are saying something very important under IFRS 2 share-based payments. We have got two types of share-based payments. We have those share-based payments, which at the end of the day will be settled using equity. Equity, we are looking at you giving those guys ordinary shares or even what we call share options. Or we have got those types of share-based payments where at the end of the day, we shall end up giving what we call bonuses or cash. Cash, which is pegged on how aggressive the management is in terms of driving the share price. If the share price goes up, then automatically shall be able to give you some bonus there. What we are calling the share appreciation rights, SAR. Now, ladies and gentlemen, please, I would want you to add something here. If it is equity-based, in terms of valuation, valuation of this obligation, in terms of valuation of the obligation, if number one, it is share-based payment, equity share-based payment, then the obligation here, the obligation is valued on the basis of fair value at grant date. So the obligation for the firm will be valued on the basis of fair value at grant date. The day one fair value. This day one fair value will not keep on fluctuating from year to year. So this figure will remain, the figure remains the same. The figure remains the same over grant date. It remains the same over the grant, or rather over the vesting period. It doesn't change, i.e., it doesn't change. 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 So if it's equity share-based, equity settled or equity share-based payment, then the obligation is valued on the basis of fair value as at the grant date. And this figure will remain the same over the vesting period. Over the vesting period, it doesn't change. It doesn't change. And then now we have got a cash settled or cash. So number two, we have what we are calling cash settled. So for cash settled, share-based payment, the obligation is always based on fair value at the end of each year. At the end of each year, i.e. the fair value will keep on changing. The fair value will keep on changing. The fair value will keep on doing what here? Changing. The fair value will keep on changing. The fair value will keep on changing. So something very important for us to appreciate from the word go. And the moment you have known this, we have basically understood the entire standard. We have understood the entire standard. So if it's a share-based, if it's what you're calling equity settled, always the fair value will be the fair value as at the grant date. But if it's cash settled, then cash settled, because of the appreciation concept, shares appreciating at the end of each year, we expect these guys to push them. We expect to push them that the share price at the end of each year should be increasing. Then to motivate them for purposes of valuing our obligation towards them, then we shall be using the fair value of those shares at the end of each year. And of course, we expect that fair value to keep on doing what year? To keep on changing. Now listen to me very, very well here. What are the journal entries? For this obligation, what are the journal entries? For this obligation,